Okay. So let's first start discussing this format from the start, right? And each and
Mhm.
everything is very simple over here. So I'll basically start from just the basics from A to Z. I'll explain all the thing over here. So if you remember, we studied first of all the normal format, which was not regarding consolidation, which was just the normal statement of profit or loss as well and financial position as well. So you
Mhm.
can clearly see that these both are, I would say, 95% same, or I can say all of them are same. The both of them are same, but the only difference is that we are creating a group of company over here, right? So remember, in consolidation we studied two companies, one was parent and one was subsidiary. So parent
Yes.
company is the one who purchases the subsidiary company, right? And subsidiary is
Mhm.
the one who is being purchased by the parent. So now
Yeah.
they don't make their own separate accounts, right? They may make it if it's their preference, but by the law they are just required to just make one group account, right? And that will be the parent responsibility to do that. So the accountants of parent will be responsible of that, the parent company. So they will draft a consolidated statement of financial position as well and profit or loss as well. But right now we're just focusing on the financial position. So first of all, as you know that we write the assets over here in every financial position statement, we write first of
Mhm.
all the assets, and the assets contain non-current as well and current as well. Now first let's discuss this head of account over here. Okay, so you can see over here it's written property, plant and equipment. This is just a short form just to save time, but PPE means the property, plant, equipment, the non-current asset chapter. Right now, the intangible assets are different. That's why they're written below. But you might be wondering what is this P plus S plus fair value
Yes.
adjustment. Let's see. Let's start discussing them so that you understand each and every head regarding this. Now, this P plus S basically means parent. P is parent. S is subsidiary. Okay, so
Okay.
what we're doing is that, like I told you in the previous notes as well, in consolidation we are doing line by line adding of all the statements of all the financial statements, right? So this is one example of line by line adding. Line by line means that we take the parents figure, then we take the subsidiaries figure, we add it together, right? But actually that's not enough. There may be some more things as well over here. Like there is one more thing, you can see fair value adjustment. So what is actually fair value adjustment? Let's take a look from here. Here is a short example over here. Okay, so let's say the carrying value, this CV is carrying value. Okay, so we have studied the non-current asset chapter already. So let's say the carrying value of one asset was 1000, right? And let's say the market value was 1200, right? So in the revaluation model, you remember that we change the asset value according to the market, that it's moving up and down, right? So over here we can see that market has moved up over here. The market in the people in the market are ready to buy this asset for $1200, right? So what would we say? That $200 is the fair value adjustment over here. That means this is, in other words, you can easily call it like revaluation. Okay, right? So what happens is that we first take the parents figure.
Sorry, the CV. Sorry, CV is the carrying.
Yes, yes, yes. It is carrying value. Let me write the full form. So
Okay.
carrying value and market value, when they're both added together, when they're the both difference of them is basically the fair value adjustment, which in other words is called the revaluation, right? Like how high the asset is being sold for. It is same as IAS 16 that we have studied before. Okay, so it doesn't matter it's of parents. This fair value adjustment belongs to parent, belongs to subsidiary, doesn't matter. It if it belongs to anyone, we just have to add it in the property, plant, equipment. Because if you see that when we studied this, I told you that whatever increase in value that is regarding the asset, that belongs to the asset, that is part of property, plant, equipment, right? So we will naturally
Yeah.
have to add that in this figure, right? So all these
Yeah.
three things make sense over here: parent plus subsidiary, and we are adding any kind of adjustment or revaluation that happened within the year. Okay, all of these items will be given to you in the question. Now let's move to second one, this one, intangible asset. It is also exactly same. So in intangible asset, we are adding the parent sum, and then the subsidiaries, and after that we are adding the fair value adjustment. So it's exactly same like property, plant, equipment. It's basically line by line adding over here. Now, the first placement of the first working over here, you can see it is goodwill. You can see it in non-current asset. I explained you that when we were studying intangible asset, if you remember, there was a small concept. I just discussed it for 5 or 10 seconds, right? And that was that, let me repeat again, that intangible assets are of two types. One is purchased, one is internally generated. right? Now internally generated is like we have worked from zero, right? Let's consider a business that has worked from zero, and now it is, selling most of its product. Customers are very satisfied. Everyone starts from zero, right? No one is perfect from the start. So that is internally generated intangible asset. It may be goodwill, it may be anything. But the example we took in the last class, Facebook purchased WhatsApp. So Facebook purchased a readily available goodwill, right, in the market. And I told you
Mm,
there are two prices to pay. One is goodwill, and the other one is the net assets of the subsidiary company.
mm,
Right? So goodwill over here, in the example that we discussed in the last class, Facebook is readily purchasing the WhatsApp goodwill. It's not generating it within, right? So it's just purchasing it from the market by just paying cash, right? So this is the only purchased goodwill. If you remember from intangible asset chapter, I told you as well that purchased goodwill only is recognized as a non-current asset. The internally generated, we just simply ignore that, right? So that's why the goodwill that we calculate in working three, it's written after that as well. W3 means working three, the last day workings, the Friday one. This is added in the non-current asset. Exact figure, we just take it from there and add it over here, because it is a proper asset of the business, right? And this asset will last for even more than 1 year. So that's why it's called a non-current asset. Okay, right.
okay.
Now there is another working which I did not do right now, so just ignore it just for a while. Like we're studying the non-current asset, just take these three in concern over here. Okay, just ignore this one for
Mm,
this point. Investment in associate. I'll come back to this in some other class because this is a separate topic of consolidation. Okay, so after writing all these non-current assets in the similar way, we are just adding parent plus subsidiary plus fair value adjustment, right? After that, we come to the current assets, right? Now, in the current assets, if you remember from the normal statement of financial position, not the consolidated one, we just had three things, right? There was prepayment as well, but that's very rare in this kind of situation, right? We are just adding the important items. So you can see over here inventory, then receivables, and then cash. Now, there are two things
yeah,
to discuss over here. One is this GIT, then this CIT, and then this PURP. These three things I'll come back to in just, let's say, 5 minutes after I explain this all, right? And let's first discuss inventory over here. So in inventory, what we're doing is parent plus subsidiary plus GIT is basically goods in transit. It's a short form of that. Okay. Actually, let me explain this first so that we get a better understanding of that. So first, let's discuss. Just give me a second. Just a second. Okay. So let's first discuss goods in transit. So there are total three words. I'll explain each of them. One was goods in transit. It was basically GIT. Then there was cash in transit, which was CIT, cash in transit. So CIT, right? And the third one was PURP. I'll tell the full form of this once I explain the first two things. Okay, so first let's discuss goods in transit. Now there are some situations in the business. What happens is that in the goods in transit, sometimes there are some purchases that the company does, right? And those are still, in transit. We have not yet received them. Maybe they are coming from abroad. Maybe they are, bulky items. They're taking much time, right? So what we do is that we just take a simple example. We actually don't need to know in detail that what goods in transit are. We just need to know the treatment of them, what to do in that case. Okay, so the treatment of them is very simple. Just assume I'm writing the treatment over here. Just assume goods have been received, because we may have been waiting for the goods over here, right? So we have to assume
mm,
that goods in transit are no longer in transit anymore. We have just received them just now, right? And the double entry for this is, I'm writing the double entry, debit inventory, because obviously if we receive the inventory, it will increase, right? Inventory is an asset. So if asset increases, it is debited, right?
yeah,
So what we have to do is in goods in transit, just assume goods have been received. And if you remember, when we purchase something, what we do, we are creating a payable, right? If you remember, we do something like this: debit pay purchases, credit payables.
yeah,
Okay, just a second, let me confirm one thing. So GIT is here, and secondly, Yeah, exactly. And secondly, what we do is we also credit the payables over here, right? So what actually we are doing, we are not we are actually doing this same double entry, but instead of debiting purchase, we are just increasing the inventory. Because right now, as you know, purchases is a profit or loss item, right? It's not a financial position item. But right now we are studying financial position, so that's why obviously it is very sure that inventory is received, right? In actual terms, what double entry we do, that is this one. But we are receiving inventory in this case, so obviously inventory will be received, it will be increased, right? And similarly we'll increase the payables as well, because now the goods have been received by us. Now the basically the credit period has begun right now. Now in 10 to 15 days we will have to pay the payables, right? So this is just the first step, which is basically delivery of the goods. The cash payment stage has not yet arrived over here. Okay, this is goods in transit, very simple to understand.
Okay.
Exactly same thing happens in cash in transit as well. Let's discuss that. So in cash in transit, there can be many examples. Like let's say some customers, we are waiting for some customers to pay, or some supplier has taken more payment from us. We are waiting from him to pay us back, right? So many things can happen. But in actual, this means that we are waiting for the cash. The cash is in transit. It's in between of transferring. Right? It has not yet been received by us. So similar case, what we have to do is just assume that cash has been received. Cash has been received. This is the simplest thing that we can understand over here. In goods in transit, we are also doing the same, that we have to assume that goods have been received. They are not in transit anymore. And similarly, in cash in transit, they are not in transit anymore. We have received them. Okay. So if we have received the cash, the entry that we do is debit, we do cash, right? And we are receiving from the customers, right? And in this case, customers will call receivables over here. So what we do is credit receivables. So
Yeah.
if you can recall, this is the same entry where, when we are making for the credit sales, when the payment is done by the customers, right? And similarly, you can see, now let me show you these both items in the format as well. So in GIT, debit inventory credit payables, right? Inventory is increasing. You can see here that GIT is being plus over here in inventory, right? And in payables, if I go to the payables over here, you can see GIT is also being added over here, right? So debit
Yeah.
inventory credit payables. Now, on the other side, this CIT, the cash in transit, you can see the receivables are being reduced because we have received cash, right? And in cash, the CIT is being added, right? Because debit cash and credit receivables. So receivables were reducing, cash was increasing. So it's all a game of double entry over here. There is nothing much to understand. Okay. Now let me go back to the notes. So these two things are clear to you. Any issues?
No, it's fine. Yeah.
Okay, great. Now let's discuss this one. This is the most troublemaking thing, and it's very easy to understand, but it's a bit tricky to understand. I'll try my best to explain it in the easier terms. Okay. Now PURP is basically, we in the short form just ignore this P. We call it URP. In practical life, the businesses call it URP. Now, what is actually this URP? It is unrealized profit. In simple form, it is called unrealized profit. Now if you remember from the inventory chapter, the IS2 chapter that we studied in the start, I guess it was chapter 5 or 6, I think. So we studied a word over there, and you remember it was realized, right? Now realized, I explained you that it is not that English word that I realize this thing, but in financial accounting this word is used for actually receiving cash, right? Now let me give you one example. uh, let's take an example of non-current asset. Same thing happened in revaluation as well. So revaluation was again an unrealized thing. How was it unrealized? Like let's say, take an example. If I have an asset for 10,000, right? Now in the market this asset has gone up to how much? 15,000. So in actual,
Mhm.
how much there is an increase in value? 5,000. So I'll take this 5,000 into the revaluation reserve. It goes into two things, the OCI, right? And the revaluation reserve under the equity section, right? So this 5,000 means that this is unrealized amount. This is just an imaginary amount. So in other words, we can call unrealized as imaginary as well, right? Because actually what happened is that, how is it an imaginary amount? We actually have not sold this asset, right? This is still lying with us.
Yeah.
This is still working day and night, producing goods, right? And selling it to customers. So this 5,000 increase is just on the paper. This is just like a short-term profit and unrealized profit, which is actually
Yeah.
not a cash item. It's a non-cash item, right? So unrealized, the synonyms of this would be non-cash and like imaginary, right? Just on paper. These all can be the synonyms of this one. Okay, right? So this is unrealized profit. Now let's discuss the detail of this. This was just the understanding of the word. This has a lot of detail over here as well. Now what happens is there is a very short thing to understand over here. We are talking about consolidation over here, right? Consolidation.
Mm-hmm.
And in consolidation, let's say this parent company, which is A company, it acquired B company. Okay, so this B company is subsidiary, this A company is parent, right? Now what happens is that in some cases, what happens is that there are intercompany sales and purchases. Okay, by
Mm-hmm.
intercompany sales I mean that this is part of one group, right? But still they are treating it as a different company. And what they do is that A company, maybe A company is manufacturing something that B company needs to have in its manufacturing process, right? Maybe this can be the reason that they purchased each other, right? So what happens is that the A company sold something to B company. Now in financial accounting, if we look at it with an open mind, it does not make sense over here. How does it not make sense? Let me give you an example. You see, it is one company now, right? It is one group. So
Yeah.
it's like I am selling from my right hand to my left hand. It is being sold within me, right? An item is being, it still lies within me. I'm selling something from my left hand to right hand, right? It is
Mhm.
still within me, right? So that means all the intercompany sales and purchases, I will discuss this in future as well. It comes in, I think, payables and receivables. After this I'll be discussing that. Okay, so first of all, remember that this unrealized profit is considered with uh, the intercompany sales and purchases. Okay, now if A company, let's say the A company is selling something which costed it 100, the cost to A company was 100, and it's sold out for, let's say, 150. Okay, so how much profit is A company earning over here? $50, right? Because for it the cost is 100, it is selling it for 150, so the profit is
But
50
it's
over here.
not the same company, so these kind of transactions are called intercompany.
Yes, 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 exactly, because they are happening within the group, right? Within one company,
Okay.
right? So in actual, I will explain this in future as well, but just remember that all the intercompany sales and purchases we have to eliminate from the accounts because it does not make sense over here, right? I will
Mhm.
come back to this in just 5 minutes. Let me first explain this unrealized profit. Okay, now let's say A company is selling something to B company. This is happening within the group, and A company, the cost to it was 100 and it's sold out for 150. So you can see there is a $50 profit over here, right?
Mhm.
Now let's say B company received these goods, right? These goods are over here, this dot, right? And the cost to B company is, let's say, 150 because they purchased it from A company for 150, right? Now what will happen is that this unrealized profit means that these both companies have actually not earned profit. It is just on paper because money is just going from one hand to the other hand, right? So this is the concept of unrealized profit. What we have to do is that we just have to take out the percentage of inventory that is left. Okay, so the rule, the treatment, I'm writing it over here. We just have to take out percentage of inventory that is remaining. Okay, so only the remaining percentage of inventory. Let's say this A company sold something to B company, and let's say there were 100 units of this product, right? And let's say these 70% of the goods, 70% of the goods, B company sold it to the other companies, to its customers, let's say, right? So how much inventory will still be left? Only 30%, right? Only 30% will be in the warehouse of B company. The other 70% will be sold out to the customers and all the suppliers, everything, everyone who is needing
Okay.
the,
Okay. Sorry.
right?
So
Yeah.
100 units. So if I mean, it's between the other suppliers and the parent, right?
This is basically between, you're talking about the 70% or the whole 100 units?
All of them. I mean, it's
So basically, A company sold to B companies that were 100 units. 100 units were sold to B company,
okay.
right? And now I'm talking about B company, that now B company has this 100 units, right? So these 100 units B company purchased to sell them out or to use them. Let's say 70% of them were used in their production, or let's say they were sold out, right? Now only 30% is remaining in the B company, right? So what we do is, in unrealized profit, is that now we cannot do anything regarding the 70%, because we cannot chase the customers, that we will say them, please give us our inventory back. That does not make sense, right, over here. Now what we do is
Sorry,
that
70% is going to.
it's going to the customers, the external customers that B company is selling to,
Okay.
or let's say B company
Okay.
used it in the manufacturing process of its own. Okay,
Okay.
right? So we are talking about just the remaining inventory. This is the key word over here, that only the unrealized profit is calculated for the remaining inventory, not for the other one, because other one has been sold out or used in a manufacturing process. We cannot reverse that, right? It will not make any
Yes.
sense over there. So only remaining inventory, we calculate the unrealized profit. And what is its implications? Let me tell you over here by looking at the format. Just a second. So first of all, what we do is that the unrealized profit is minus from the inventory, right? And the other aspect is that it is added in the cost of sale, right? I'm writing the treatment over here of this one. Just a second. So the unrealized profit, what happens is that this is added.
Sorry, and that 30% is the unrealized profit.
Yes, exactly. So basically, the 30% inventory will have. The, let's calculate the profit over here. Okay. So I am telling you that we calculate the remaining inventory profit. Only we deal with the remaining one. So the profit over here is how much? 50, right? $50. So what we do is 50 multiplied by 30%, because only 30% inventory is available with B company, not the other one. So what we do is this will give us, I think, the answer of 15, right? So out of $50, $15 is still remaining within the B company, that we will have to eliminate, right? And the remaining 70% we cannot do anything about it, because it's sold out to the customers.
Why do we have to deduct it?
We are actually not deducting it. I'm telling you the treatment, what we are doing. So it is added
Okay.
in the cost of sales. It is added in cost of sale, and deducted from it is deducted from the inventory figure. Okay. Now you can see over here as well, if I show it in the Excel file, you can see that inventory is, the PURP is being minused over here, right? And we'll study the profit or loss as well, but I'm not looking at that right now. So it is added in the cost of sale in the profit or loss. So this is statement of profit or loss. This is statement of financial position, right? So this is the implication of that. Why are we deducting from inventory and adding in cost of sale? So basically what we're doing is that the inventory does not have these 30% item, right? We are basically eliminating them. The 70% have been sold out. The main thing which I told you over here regarding the intercompany sale is elimination, right? Eliminate, sorry, the spellings are wrong. Eliminate. So we have to eliminate it from the accounts, and for that we have to deduct the inventory and increase the cost, because there is a concept as well that we'll study in future. It is called matching concept. Let me give you an introduction of that as well. So matching concept is very easy. Let me give a practical example. So for every sale we are doing to the customers, sale is generating an income, right? So for every income there is some kind of cost to that as well, right? Let's
Yeah.
say if I'm selling a shirt to the customer, right? This shirt is being sold to the customer. Now this is
Yeah.
generating me an income which will be in the form of profit, right? So this is my income, but at the same time there is some kind of cost or expense as well, and that expense will be the price of this shirt to me,
Yeah.
right? The price of all the electricity in the store, the price of the, for example, the internet that the store is using, the price of per unit. You will study this in F2. You might have studied this as well, the marginal costing and absorption costing. So
Yeah.
it's
Yeah.
something same like that. So what happens is we are matching the income with the expense, because every kind of income has an equal kind of expense that belongs to that, right? So income will be some kind of profit over here. Expense will be like the cost of shirt, the cost of employees, a portion to every unit, right? So this is the matching concept. That's why what we're doing is we are deducting from the inventory and we're adding it in the cost of sales. So over here, the good thing is that we just need to remember the treatment. There is not much explanation of this at this point. Okay, because separately, if we look at this topic, the unrealized profit, the URP, it is a very, very long topic. That's why they have not included much detail of this in F3 level. But yes, certainly it is available in F7 in the future paper. Okay,
Yeah,
so just
I'm just thinking because why is why is deducted from the inventory if we still have the inventory in?
because look, I wrote the word over here. Let me write this again. Eliminate. What we have to do is any kind of profit, any kind of intercompany sales, any kind of amount that is linked with the intercompany sales or purchases, either it's profit, anything, we have to finish it out. We have to eliminate it, right? So it will be present in the inventory right now. We have to just deduct it out. We have to just finish it, right? And why we're adding in the cost of sale to just equal this out. If we are crediting the inventory, we have to debit something as well, right? Again, the matching principle,
Yeah.
this one, right? So just the treatment you need to remember over here that we have to make a debit entry as well and credit as well. Okay, so the correct double entry, let me also write that over here. So credit we do inventory, right? And debit we do over here cost of sales, just to make it equal. Because why we are debiting cost of sale, why not expenses or why not other income? Because you see, cost of sale, what is the formula of cost of sale? Opening inventory plus purchases minus closing inventory, right? So that's why inventory is present in cost of sale, so it is favorable to post it over there, because it consists of inventory, both opening and closing as well. Okay, right, got it. And one more logic
Yeah,
you can
just
also,
yeah.
one more thing you can also understand, that if we are crediting inventory, this is the statement of financial position, right? And in SOFP, I told you the closing figures are written over here, only the closing figures, nothing else, right? So if the closing figures are written, the cost of sale, let me write the full format of this. So this is opening inventory plus the purchases minus the closing inventory, right? So basically, closing inventory is being deducted from cost of sale. In other words, we can say it is reducing the cost, it is reducing the expense. So it is a credit item, we can say, right? So that's why we are adding it equally in the cost of sale as well, because we are adding it as an expense and we are deducting it in the inventory in this statement of financial position. Okay, right? So we just need to remember the treatment, which is this one that I just wrote. It's added in cost of sale and deducted from inventory. Okay, because apart from learning just this one, there is actually not any kind of proper explanation for this topic for unrealized profit.
I can also think like in the way that inventory is on the credit side because it's the closing inventory and the opening inventory is on the debit side.
Yes, you can also remember it like that, yeah, if you find that easy.
Yeah.
Because we, again, it's something like matching, right? So if we are reducing the closing inventory, we have to take the effect to opening inventory as well,
Yeah.
right?
Yeah.
Both things will decrease equally. Okay.
Yeah, I will remember like that. Yeah.
Yeah, yeah, sure. Right. So the three things are discussed over here: the goods in transit, cash in transit, and unrealized profit. Just the last thing we're discussing, which is basically the intercompany transactions, and this contains the sales as well and the purchases as well. Intercompany sales and purchases. Okay. So in this, what we do is that there is just a simple treatment to remember, that this is eliminated from the financial statements. Just a simple rule. Because I already told you the logic behind this, that it does not make sense that within one company this is happening, right? If one hand is selling to the other hand, it does not make sense. Still, it is within the group. Still, it is within the whole company,
Yeah.
right? The cash will be moving in and out within one room to the other room, but it's still one factory, one company, right? So
Yeah.
this is the explanation for the intercompany sales and purchases. The effect you can see over here as well. I was just going to explain receivables. You can see intercompany balance is minus. This is intercompany receivables, right? And intercompany payables is also minus from here, from the payables, if we have any.
Okay, I will
Okay.
just remember always minus.
Yes, yes, exactly. It will be minus from payables as well and receivables as well. So the double entry
Okay.
basically will be debit payables, credit receivables. We have to eliminate it, right? Let me write the double entry as well. So what we do
Yeah.
is debit payables, we are reducing the payables, and credit receivables. Okay, right? This is the double entry for intercompany sales and purchases.
Okay.
Okay, right? Now, let's continue to discuss all these. So inventory we were done with. So parent plus subsidiary plus the goods in transit because we have received them, and minus the unrealized profit because this does not belong in the inventory. Now for the receivables, what we do is parent plus subsidiary. This CIT I've explained already, because in CIT what we do is we assume the cash is received now, right? And if the cash is received, the double entry that we make is debit cash, credit receivable. So in theory, we are
Okay.
finishing the receivables, right? And the intercompany balance is minused over here. Similarly, in cash, parent plus subsidiary plus the cash in transit, because the cash in
Okay.
transit is assumed to be received. That's why cash is increased over here, right?
Yeah.
Now this gives us the total figure of total assets, right? If we add the non-current and the current, we are given with the total assets over here. And this
Yeah.
total assets, again, it should be equal to total liabilities and equity, exactly the same process as the accounting equation.
Mm-hmm.
Okay, right? Okay, now let's come towards equity and liabilities, right? So equity has some kind of restriction, some implication that I'm telling you over here. So first of all, we write the first two amounts as you can see over here. The first two amounts are share capital and share premium. We are
Yeah.
writing these two as parent only, parent only. Now, this is a very important discussion. Why we are writing parent only? Let me explain this with full logic. Now, if you remember the workings, if you remember even like 5-10% of it, the working two, if you remember, working two was net assets of subsidiary company, right? And if you remember, we created two columns, right? We created a line which had on the left side was acquisition date and the right side was reporting date, right? And the
Yes.
difference between the total is called post acquisition profits, right? Now, in the that the working two was basically a full working dedicated to the subsidiary company. It did not have
Mm-hmm.
anything related to the parent, right? So the reason why we are writing share capital and share premium of only the parent is that in working two we already wrote the subsidiaries capital and premium, the share capital and premium, if you remember, right? So if we have already written it in working two, there is no use of showing it over here because that's already adjusted over there, because those workings are also contributing towards this statement, right? Right, it has contributed towards goodwill as well, because in goodwill, if you remember, we minus the net assets at acquisition date, so it contains the effect of that. So that's why we are only writing the parent company's share capital and share premium in the equity section, right? The first two things over here. Now third thing, you can see revaluation surplus. This will be given to you. This is most probably the parent plus subsidiary. It's not written over here, let me write it. So this is parent plus subsidiary. Okay, this will be given to you in a question. This is not very much important. Okay, now this is the main thing, group retained earnings. If you remember working five, I told you it was purely dedicated to which company? The parent company, because it had all the profit, the post acquisition profit share of parent, the retained earnings of parent, all those things which are related to the parent. So that's why we are adding this as well, because it's a readily made figure that is has already been
And
calculated.
that okay, and that was what was the parent, the retained earnings of the parent plus the difference of
Yes,
the
yes,
work,
of
the
the post
working.
acquisition. Yes,
Okay.
exactly, of the working two, exactly, right? Now I also told you to just leave 1 or 2 lines. If you've not done that, no problem, because as we move forward in consolidation, this is the second day of consolidation, probably it will take 3 or 4 days, right? So we are halfway there, you can say, or let's say 60% we are there, because this is a huge topic, consolidation. So the reason I told you to just leave the lines is because as we move forward, there will be 1 or 2 more things in this. The formats that we already discussed, the workings that we've already discussed, there may be 1 or 2 things more, like unrealized profit, all these things, because we have come across them today, right? Okay,
Mm.
but those will be looked at in future, hopefully. Okay, so this was the explanation for equity. These 4 things are there. We just need to take care of these first two. This does not need to have the subsidiary one because it's already written in the working two. Okay, now we write the one more thing, which is non-controlling interest, and this was calculated in working for. The working for was dedicated to NCI, non-controlling interest. And if I recall, it had two things. First one was the fair value of NCI, like what is the market value of the non-controlling interest, right? And secondly, it we added the NCI share of post-acquisition profits, the NCI share of the difference of working two items, right? So the answer of this, the working for, we'll write it over here because this is a part of equity as well, because equity contains the whole value of the company, right? What is the market value of the full company, right? So we have to include the non-controlling interest as well as the parent, because these are the two who are owning the company, right? Now we move towards liability over here. Liabilities also have two items, non-current liability and current liability. So non-current is very simple. You can see loan, the long-term loan, which is preferably more than 1 year, more than 12 months. So parent plus subsidiary. Now we are minusing the intercompany loan over here. Why we are minus over here? Because this is intercompany balance. Again, this is not a sale or purchase, but still it is intercompany. Let's say the parent company may give some kind of a loan to subsidiary company, right? So that loan is also like cash is moving within the business, right? Within one company. So it does not again make sense. So any kind of intercompany balance, either it's a loan, either it's a sale, purchase, receivable, payable, it is to be eliminated from the financial statements. Okay, right?
Mhm.
So this is also minus, and we get the total of non-current liabilities over here. Now, lastly, there is current liabilities. So payables, in payables, what we write is parent plus subsidiary, right? Plus the GIT. If you remember goods in transit, what we did is debit inventory, we increase the inventory and we increase the payables as well, right? So parent plus subsidiary plus GIT minus intercompany balance. If there is any kind of intercompany, again, we are eliminating that, right? And lastly, we have bank overdraft. This is very simple, parent and subsidiary. Okay, just line by line item adding of this, nothing else over here.
Okay.
Okay, so
Can I
if
ask
we
you
add,
something?
yeah,
In the
yeah.
exam,
Hmm.
is there going to be like, the structure of it, or we have to basically, I mean, all the headers are already there, or do we have to, to memorize also, how it is structured?
Yeah, so basically what happens is that I'll explain you that. So in exam there are basically two kind of question. If you remember, one was section A, one was section B, right? If you remember from the first day. So in section A, what we do is we have 35 MCQs. Now the good thing is that in section B, there will be a question on consolidation, the 15-mark one, as I was telling you before. So that will have, the good thing is that it will have the formats already made. Okay, so
Okay.
only let's say five or six things will be missing. All the others one will be written, and there will be a drop down menu of all that. Let's say all of this is a statement of financial position. This is made, and there is a extract which shows like calculate the working five. All of these three things are written. Calculate working five, right? So good thing is that we need to remember the formats over here, the working specially, because these will be asked in both the MCQs as well and the structured questions as well, the section B, right? So formats will be given over there, but the thing is that we have to learn, we have to basically memorize the workings over here, which are very important.
Yeah, the calculation. Yeah.
Yes, yes,
Okay.
yes, exactly. Okay, so once we get the current liabilities, we add them all up, and this is total liabilities and equity. Now you can see this is also coded in red, and the total assets was also in red. So these two should be
Yeah.
equal to each other. Okay,
Okay.
right? So this was the full explanation for the consolidated statement of financial position.